your first step into the world of automated trading. Welcome to the world of modern finance. It is a world driven by technology. It is a world where decisions are made in microseconds. You might have heard terms like algo trading, HFT. They might sound complex or intimidating. The reality is both simpler and more fascinating. This guide is your starting point. Think of this as your first lesson. We will break down complex ideas into simple, manageable pieces. We will start with the basics of what algorithmic trading even means, then explore high-frequency trading and more. Let's begin. Chapter: What is algorithmic trading? So what exactly is algorithmic trading? Let's strip away the jargon. At its core, algorithmic trading or algo trading is simply using a computer program to make trading decisions. That is it. The program follows a predefined set of instructions or an algorithm to enter and exit trades. These instructions can be based on anything you can quantify: timing, price, volume, or complex mathematical models. Instead of a human watching the screen, a computer does the work automatically. Let's use a very simple example. Imagine, buy 100 shares whenever the stock price drops below its 50-day average, and sell when the price rises 10% above your buy price. Manually, you would watch charts all day, calculate averages, and risk missing the moment. With algo trading, you write the rule into a program. It monitors the market 24/7 and executes instantly when conditions are met. Automation brings key advantages: speed, accuracy, and discipline. Algo trading is broad, from simple rule-based systems to complex quant models and strategies holding positions for months or for milliseconds. Chapter: High-Frequency Trading, HFT, explained. High-frequency trading is algorithmic trading taken to the extreme. It is all about speed. HFT firms use powerful computers, advanced algorithms, and ultra-fast data connections to execute many trades in fractions of a second. The goal isn't one big trade, it's tiny profits on millions or billions of trades. Think of a supermarket making a few cents per can, but selling thousands a day. They buy for $10.000001 and sell for $10.000002, tiny margins that add up. To win this race, they invest in technology and location. Co-location places their servers inches from the exchange servers. Common HFT strategies include market making, earning the spread, and arbitrage, exploiting tiny price differences across venues. It's a race for pennies run at the speed of light. Chapter: Manual Trading versus Algorithmic Trading. Manual trading is what most people picture: a human using experience, intuition, and analysis to decide. They read reports, study charts, follow news, and manually place orders through a broker. Algorithmic trading outsources execution to machines. The human designs, tests, and oversees the system. The human becomes the architect, building the rules, running back tests, and monitoring live systems. Once switched on, the algo runs non-stop. The role shifts from active participation to strategic oversight. The biggest differences are speed and scale. A human manages a handful of positions. An algorithm can monitor thousands and execute hundreds of trades per second. Emotion is another divider. Humans feel fear and greed. Algorithms execute discipline without emotion. An algo will cut losses or take profits exactly as coded, without hesitation. That systematic execution is a powerful advantage. Chapter: The Role of AI and Machine Learning in Markets. We talked about fixed rule algorithms, but what if the algorithm could learn and adapt on its own? Think of a standard algorithm as a calculator. An AI model is like a student given a library of market data to learn patterns. Machine learning models train on decades of prices, volumes, economic reports, and more to find subtle relationships humans may miss. The model sifts this ocean of info to discover signals. For example, complex correlations between oil prices, FX moves, and a tech stock. Once trained, it applies learned knowledge to live data and can even generate strategy rules for developers to test. AI can analyze unstructured data, news headlines, social media, scoring sentiment quickly and factoring it into decisions. This is not a magic bullet. Models suffer from data drift and model decay. They require careful construction and ongoing monitoring. The human role shifts to data scientist, systems manager, and risk manager, building, validating, and maintaining ML pipelines. When done well, AI uncovers new signals. When done poorly, it produces false positives. So validation and controls are essential. Next, we will discuss risks and ethics of high-frequency trading. Chapter: The Risks and Ethics of HFT. High-frequency trading is powerful, but not without dangers and ethical dilemmas. Because systems operate at extreme speed, a small bug can send millions of orders and cause catastrophic consequences before a human can react. These rare events can shake market stability. Remember the flash crash of May 6, 2010? Proponents say HFT provides liquidity, narrows spreads, and reduces costs for regular investors. Critics counter that liquidity can be phantom. Orders appear and vanish, and algorithms can withdraw during stress, worsening crashes. Is it fair that some firms buy advantages like co-location and direct feeds unavailable to average investors? Does this create a two-tier market? Critics also highlight predatory tactics like quote stuffing, placing and canceling orders rapidly to confuse others. Regulators worldwide wrestle with balancing innovation and fair, orderly markets. You won't become an expert HFT programmer here, but you now have a clear foundation of what it is and how it works. The machines are here. With knowledge and responsibility, we can make markets more efficient and fair.